So from February the 1st, 20% of new mortgages issued by banks are allowed to have debt-to-income ratios of more than 6 times.
While APRA says overall bank lending standards remain sound, it's noticed a pickup in some riskier lending as interest rates fall and house prices surge. It comes as the number of new loans climbed, according to the ABS.
It could become even harder to break into the housing market next year. The banking regulator is cracking down on risky loans, ordering lenders to cap the number of high debt-to-income mortgages they approve to 20% from February.
February the 1st, 2026. Mark that date, because on that day, one rule change will decide whether you can borrow enough to buy your next property or get shut out completely. Property investors are about to hit a wall. First home buyers might finally catch a break. And if you're planning your next move in the property market, what you do in the next 2 months could be worth hundreds of thousands of dollars. The banking regulator just dropped restrictions that are already causing panic in investment circles and confusion among first-time buyers. I'm going to show you exactly who wins, who loses, and the one move you need to make before the deadline hits. Starting February the 1st, banks can only approve 20% of their new home loans to borrowers who need more than 6 times their annual income. If you earn $100,000, borrowing over $600,000 puts you in the restricted category. John Lonsdale was clear about why they're doing this. Rising household debt has historically been linked to riskier lending and rapid price growth. With interest rates falling and confidence returning, the regulator wants to prevent the dangerous lending behaviour that caused problems in previous booms. The limit applies separately to owner-occupier and investor loans, so banks must track both categories independently. There are some exceptions though. The rules don't apply to bridging loans or purchases of brand new dwellings. The government carved these out to ensure new construction isn't accidentally stifled, while Australia desperately needs more housing. To understand why APRA is stepping in now, look at what's been happening in the market. In the September quarter of 2025, investor lending jumped by a massive 17.6% in just 3 months. Owner-occupier lending grew too, but at a much slower 4.7%. Property investors now account for more than 40% of all new home lending, approaching the highest levels we've seen in recent years. Over the past 12 months, investor lending grew 18.7% year on year, while first homebuyer loans only increased by 2.3%. Commonwealth Bank CEO Matt Comyn told Parliament last week that even his bank believes home lending to investors is at unsustainable levels. When the biggest lender in the country is saying things are getting out of hand, you know, regulators are paying attention. Housing prices have been climbing steadily too. National dwelling values are up 6.1% annually as of October 2025. Perth led the charge with 1.9% growth in just 1 month, Brisbane followed with 1.8%, and Darwin saw annual growth hit 15.4%. The Reserve Bank has cut interest rates 3 times in 2025, in February, May and August, after keeping them high for years. Those cuts have already started boosting people's borrowing power. RBA Governor Michelle Bullock even said publicly that she expects house prices to rise as rates fall. That's just how monetary policy works. Lower rates make borrowing cheaper, which increases demand, which pushes prices up. APRA remembers what happened in the mid-2010s, when investor lending got out of control and they had to step in with even stricter rules, putting a 10% annual cap on investor loan growth between 2014 and 2017.
To 2014, APRA introduced an investor mortgage limit. In 2017, it imposed a new rule saying only 30% of new residential loans could be interest only, and house prices have never been higher.
They don't want to wait until things get that bad again. So, who's going to feel this change the most? Property investors, without question. The data shows they typically borrow at much higher debt-to-income ratios than people buying homes to live in. When you're buying your 3rd or 4th investment property, you're usually stretching your borrowing capacity to the limit. Mortgage broker David Thurmond from Mortgage Choice in Victoria explained it perfectly. Most first home buyers or owner-occupiers rarely borrow more than 6 times their income because existing bank rules already stop them. But clients coming back for their third or fourth investment property are the ones who might have trouble under the new limits. Here's a real-world example. Imagine someone earning $120,000 a year who already owns 2 investment properties. Under the old system, they might be able to borrow another $800,000 or even $900,000 for a third property. But at 6 times their income, they'd be capped at $720,000. That extra borrowing capacity makes the difference between buying in a decent suburb or having to look further out or not buying at all. The new rules will also hit property investors who have other debts hard. If you've got car loans, personal loans, or credit card debt, those obligations reduce your income for lending purposes. A first-time investor with a car loan and personal loan might suddenly find themselves unable to borrow enough to get into the market at all. For first home buyers, the impact will be much smaller. Most young Australians buying their first property aren't earning enough to borrow 6 times their income anyway. The median first home buyer loan is around $555,000. To hit the 6 times limit at that loan amount, you'd only need to earn about $92,500. But most first home buyers earn less than that. And the banks already have strict rules about how much they'll lend based on your expenses and living costs. That said, there's a small group of high-earning first home buyers who might feel the pinch. Think about professional couples in their early 30s, both earning good salaries in Sydney or Melbourne. They might have combined income of $200,000, and with a 20% deposit, they could theoretically buy a property worth $1.5 million or more. Under the new rules, borrowing more than $1.2 million would put them in that restricted category. But here's an interesting twist. Single buyers might actually benefit in a weird way. With investors potentially slowed down by the new rules, there might be less competition at auctions and private sales. Finder's 2025 First Home Buyer Report found that 61% of first home buyers missed out on at least one property they seriously wanted. Anything that reduces the bidding wars could help. Now, let's talk about what this 20% limit actually means in practice. Right now, according to economist Zach Gross from Monash University, only about 10% of new investor loans fall into the high debt-to-income category. APRA itself said that at an aggregate level, the limit isn't currently binding. Only a small number of banks are expected to be close to the limit for high debt-to-income investor lending right now. So, for most borrowers, nothing changes immediately. But that's exactly APRA's strategy. They're not trying to slam the brakes on lending today. They're putting a speed limit in place before anyone starts speeding. John Lonsdale called it a preemptive measure to contain risks before they build up. Australia already has some of the highest household debt in the developed world, and adding more high-risk loans on top of that existing debt pile makes the regulator nervous. They've seen this movie before in previous property booms. High debt-to-income lending started small but grew rapidly. By the time regulators realised it was a problem, they had to implement harsh restrictions that caused major disruptions. Banks still have to apply stress tests to every loan too. They must make sure borrowers can still afford their mortgage if interest rates rise by 3 percentage points above the loan rate. This is separate from the debt-to-income limit. You might pass the debt-to-income test, but still fail the stress test if your expenses are too high. Everyone wants to know whether these new rules will bring down property prices or at least slow their growth. The honest answer is probably not by much, at least not immediately. Multiple experts, including mortgage brokers and economists, have said these changes won't make a huge difference to house prices in the short term. The limit is set at a level where most lending is already happening below it. And remember, it doesn't apply to new home construction, which is a significant chunk of the market. Dr. Andrew Powell from the Property Investment Professionals of Australia put it well. He said, "The cap creates a mechanism that automatically slows high-risk lending if it accelerates, but it won't alter the structural forces driving the market. Those structural forces are things like strong population growth, tight rental conditions, limited construction capacity, and an ongoing shortage of new housing. Australia's population is growing fast, mostly through immigration. The government brought in over 500,000 migrants in recent years. All those people need somewhere to live. But housing completions in June 2025 were 15.6% below the decade average. Supply isn't keeping up with demand, and that fundamental imbalance pushes prices up regardless of lending rules. Rental markets are extremely tight across most capital cities. Vacancy rates are sitting around 1.5% nationally, which is near record lows. When rentals are scarce, investors can charge higher rents, which makes property investment more attractive, which brings more investors into the market. The new APRA rules might slow that cycle a bit, but they won't solve the underlying rental shortage. Construction costs have been rising sharply too. Builders are dealing with higher material costs, labour shortages, and regulatory delays. CoreLogic's data shows national dwelling values have increased 382% over the past 3 decades, with an average annual growth rate of 5.4%. That long-term trend reflects Australia's chronic housing undersupply. Some markets might see bigger effects than others. Sydney and Melbourne, where prices are highest and investors are most active, could see more of a cooling effect. There's also a timing factor to consider. Some investors might rush to get their loans approved before February 1st, creating a mini boom in late 2025. Then, lending might drop off sharply in the first few months of 2026 as banks adjust to the new limits and borrowers figure out the new rules. Federal Treasurer Jim Chalmers came out strongly in support of APRA's decision, saying the rule changes are an important way for the regulator to reduce risk in the economy and will also help get people into homes. But not everyone thinks APRA went far enough. The Australian Greens welcomed the move, but said it's not enough to cool what they called investors' stampede of the housing market. Greens housing spokesperson Barbara Pocock pointed out that investor lending grew 20% year-on-year in the September 2025 quarter, while first home buyer loans only increased 2.3%. She called for APRA to bring back the type of restrictions they used in 2014 when they put a 10% annual cap on investor loan growth. APRA left the door open for tougher measures if needed. John Lonsdale said explicitly that they will consider additional limits, including investor-specific limits, if they see macro-financial risks rising significantly or if lending standards start to deteriorate. This is a warning shot to the banks. If they find ways around the rules, or if lending gets even more aggressive, APRA can and will crack down harder. The big banks seemed relatively unfazed by the announcement though. Commonwealth Bank shares actually went up slightly on the day, and National Australia Bank and ANZ both edged higher too. The market interpreted APRA's move as mild and manageable rather than a major disruption to their business. If you're trying to buy your first home, these new rules probably won't directly affect your ability to get a loan, but they might affect the market you're buying into in subtle ways. The good news is that with investor lending potentially slowing down, you might face less competition at auctions and open homes. The bad news is that these rules don't do anything to address the core affordability problem. According to Finder's research, only 16% of Australian suburbs are affordable for the average person to buy in 2025. That's down from 57% in 2017. Prices have just gotten way too high relative to incomes, especially in Sydney and Melbourne. First home buyers are already struggling with massive challenges. The same Finder report found that 65% of recent first home buyers are already in mortgage stress, or expect to be. That means spending 30% or more of your gross income on mortgage repayments. The average time it takes to save a deposit has ballooned to about 10 years nationally. In Sydney, it's even worse at 15.7 years for the average person to save a 20% deposit. Many first home buyers are having to compromise. Finder's data shows 70% of first home buyers in 2025 won't wait to save the typical 20% deposit. They're going in with smaller deposits and paying lenders' mortgage insurance to get into the market faster. almost half paid more than they budgeted because of competition or fear of missing out. That fear of missing out is a huge driver right now. The percentage of first home buyers who bought because they worried prices would become too expensive increased from 31% in 2022 to 38% in 2025. Government schemes like the Home Guarantee Scheme and the new Help to Buy shared equity program are trying to help. The expanded 5% deposit guarantee scheme lets first home buyers get a loan with just a 5% deposit without paying lenders' mortgage insurance. The Help to Buy program launching in late 2025 will let the government take up to 40% equity in your home if you qualify. These programs are helpful, but they also add complexity around income limits, property price caps, and other eligibility criteria. If you're a property investor or planning to become one, you need to start thinking strategically about these changes. First, understand your current position. Calculate your debt-to-income ratio across all your loans. Add up all your property debt, car loans, personal loans, and credit cards. Then divide that total by your annual pre-tax income. If the number is below 6, you're fine under the new rules. If it's above 6, you might be in that restricted category where banks will be more careful about lending to you. Second, consider getting pre-approved before February 1st if you're planning to buy soon. Banks can honour pre-approvals for a certain period, usually 3 to 6 months. Getting your approval locked in under the old rules might give you more borrowing power than waiting until after the changes take effect. Third, think about your loan structure. If you have investment properties with high interest rates or poor loan structures, now might be a good time to refinance. The data shows over 46,000 investors refinanced in the June 2025 quarter. Focus on properties with strong fundamentals too. These new rules are APRA's way of saying the market might be getting a bit frothy. When regulators step in to cool things down, it's a sign that you should be more conservative in your investment choices. Look for properties with solid rental yields, good capital growth prospects, and locations with strong employment and infrastructure. And honestly, consider whether this is the right time to expand your portfolio at all. If you're already stretched financially, or if you'd need to borrow at very high debt-to-income ratios, it might be smarter to consolidate your existing investments and build equity before adding more properties. The long-term outlook for property investment in Australia is still positive. The country has chronic undersupply, strong population growth, and a culture that values property ownership. But the next few years might be more volatile than the past. Some investors are looking at regional markets where prices are lower and rental yields are higher. Darwin, for example, has seen incredible growth in 2025 with annual gains of 15.4% and strong investor interest. Perth and Brisbane have also been standout performers. These markets offer better value than Sydney and Melbourne, and the debt-to-income ratios are more manageable because property prices are lower. APRA's new lending limits are part of a bigger story about how Australia manages its housing market and its financial system. The Reserve Bank uses interest rates to manage the economy. Lower rates stimulate growth, but also push up asset prices, including housing. Higher rates cool inflation, but hurt borrowers and can crash property prices. APRA's job is different. They're the prudential regulator, which means they focus on keeping the financial system safe. They don't care as much about whether property prices go up or down. They care about whether banks are making risky loans that could cause problems if the economy turns bad. That's why APRA uses what they call macro-prudential tools. These are restrictions on lending that apply across the whole system to reduce systemic risk. The debt-to-income limits are one such tool. The 3% interest rate buffer that banks must use in stress tests is another. These tools have been used successfully in other countries. New Zealand has had debt-to-income limits for years, and the UK has similar restrictions, but they're not a magic solution to housing affordability. No amount of lending restrictions will solve Australia's housing crisis as long as we're not building enough homes. The country needs about 240,000 new dwellings per year to keep up with population growth. And we're not hitting that target. State and local governments control most of the levers that affect housing supply planning rules, zoning regulations, infrastructure charges, and development approval processes all matter more for long-term affordability than anything APRA or the RBA does. But those reforms are politically difficult and slow to implement. If you've been on the fence about buying an investment property, you need to make a decision soon. Waiting until March or April 2026 might mean finding yourself in a very different lending environment. APRA will be watching the data closely too. They've made it clear this is not a set and forget policy. If high debt-to-income lending continues to grow rapidly, they can tighten the limits further. Interest rates will play a huge role in how this all unfolds. The RBA's decisions over the next year will affect borrowing capacity far more than APRA's limits. If rates keep falling, borrowing power goes up, which increases demand, which pushes prices up. If rates stay steady, or even rise again, the housing market will cool regardless of what APRA does. The political dimension matters too. We're likely headed toward a federal election in 2025, and housing affordability is shaping up to be a major issue. APRA's new lending rules mark a turning point in how Australia's housing market is regulated. For the first time in years, authorities are stepping in to actively limit lending before problems emerge rather than waiting until things get out of hand. Whether these measures prove to be enough remains to be seen. But one thing is clear. The days of unlimited borrowing and rapid investor-driven price growth are being reined in, and everyone in the market needs to adjust their expectations accordingly. If you found this breakdown helpful, make sure to check out the next video coming out tomorrow. Make sure to subscribe and like the video for more.